Four things just happened, and together, they tell you the paper-silver game is losing control. Washington just moved toward a floor under critical minerals. North America's biggest silver miner just showed buyers paying far above the quoted market price. America's largest online bullion dealer just admitted the shipping chaos finally eased after a month of strain. And tens of thousands of in-the-money March silver calls are still sitting there, alive, after one of the most violent smashes this market has seen. That is what this video is about. What just happened, why it matters, and why the next move in silver could be far bigger than most people are ready for. Because if these four signals are pointing at the same thing, then the conclusion is brutal. The price on the screen is not the real price of silver. The screen is showing you a paper number. The real market is happening underneath it, behind it, and in some cases directly against it. And when the paper number starts losing the argument to physical demand, to policy, to mine-level transactions, and to delivery pressure all at once, the market does not stay calm for very long. Start with the biggest piece. The United States just moved forward with a system designed to support critical mineral prices. A government does not step in to discuss floors, support mechanisms, and allied coordination around strategic materials unless it believes the market is malfunctioning. Governments do not do this because everything is healthy. They do it when they think pricing has become distorted, when supply chains are vulnerable, and when leaving it alone is no longer acceptable. And silver sits right in the middle of that discussion. Silver is not just a shiny metal in a vault. It sits inside solar infrastructure, electronics, defense systems, semiconductors, industrial machinery, and an economy that keeps pretending it can modernize without a secure metal base. So when policymakers start talking like critical materials need protection from broken price discovery, that is not background noise. That is a giant signal. Read the message carefully. The implication is that some strategic materials are too important to be left at the mercy of manipulated, distorted, or politically vulnerable pricing structures. Once the market realizes a strategic metal may be operating with official support underneath it, the narrative changes instantly. It stops being just a trade. It becomes a protected resource story. It becomes national strategy. It becomes industrial policy. And once a metal enters that category, every ounce gets revalued. Now think about the timing. This did not happen after silver was soaring uncontrollably. It happened after silver had already been smashed down from its highs. In other words, the discussion did not emerge because the market was overheating. It emerged because officials were looking at the existing price environment and treating it as insufficient, unstable, or strategically dangerous. That is the part people are missing. A floor conversation at elevated prices is one thing. A floor conversation after a brutal collapse is something else entirely. That sounds a lot like an admission that the market is pricing the metal too low. If that sounds extreme, look at what the miners are telling you. Because this is where the story stops being theoretical and starts becoming measurable. One of the biggest silver producers in North America just released numbers that should have been a headline everywhere. The benchmark average for silver in the quarter was far below what the company actually realized when it sold its metal. The market printed one number. The miner got a much higher number. Not a tiny premium, a massive one. That matters because miners are not supposed to live in a fantasy world detached from the quoted market. If the posted benchmark says silver averaged one level, and a major producer consistently realizes a price dramatically above that level, something important is happening. Either sales were timed with surgical perfection, or buyers were willing to pay up for real metal. And when the premium is that large, the second explanation becomes hard to ignore. This is what a physical disconnect looks like in the real world. Not a tweet, not a rumor, not a conspiracy thread. An audited financial result showing a producer achieved prices that make the paper quote look incomplete. That is the kind of evidence that forces you to ask the uncomfortable question. If the quoted market is the real market, why are actual industrial buyers paying so much more to secure supply? Because that is the hidden story now. Buyers do not want promises. They do not want synthetic exposure. They do not want settlement games and rollover theater if they need metal for manufacturing, supply commitments, or strategic inventory. They want the silver. They want it on time. They want it in size. And when they stop trusting the exchange to provide that with certainty, they go around it. They go directly to mines, directly to suppliers, directly to the source. And the moment that starts happening in size, the quote on the screen becomes less informative. This is why that miner premium is so important. It fits a larger pattern. Physical silver in parts of Asia has traded above the paper price. Lease rates have shown stress. Direct supply deals have bypassed traditional channels, and now a major North American producer is showing you realized prices that sit well above the benchmark. One data point can be noise. 4 or 5 aligning together is a signal, a very loud one. And it gets louder when you look at what the company is doing with its own capital, because actions matter more than words. This producer is not behaving like silver is a finished story. It is not acting like the best years are behind it. It is leaning harder into silver, spending more on exploration, repositioning its asset mix. Those are not the moves of management teams that think the opportunity is fading. Those are the moves of people who believe the market still has not caught up to reality. If you were running a major mining company and you thought silver had already peaked, would you intensify your silver focus now? Would you make larger bets on future production, future reserves, future development? Or would you take the money and step back? The answer is obvious. When operators closest to the ground, closest to the ore body, closest to buyers, and closest to the cost structure are leaning in instead of cashing out, it tells you they see something the broader market still does not. Now bring in the third signal, because this one hits the retail side of the market directly. America's largest online precious metals dealer just told customers that shipping times and service levels have returned to normal after a period of extraordinary strain. But the real story is not that things improved. The real story is that the system was pushed that hard in the first place. A company with scale, inventory systems, supplier relationships, fulfillment infrastructure, and decades of market experience does not suddenly struggle for weeks unless demand and supply friction became overwhelming. That is the story. For about a month, this market was not functioning smoothly at the dealer level. Products thinned out, lead times stretched, customer service pressure surged, order volume blew out expectations. The machine was overloaded. Why did it suddenly get better? Did the structural shortage disappear? Did the long-running deficit vanish? Did mine supply magically expand? Did industrial demand shut off? No. What changed was price action. A huge crash scared people, cooled buying pressure temporarily, and gave dealers breathing room to catch up. That is not the same as a healthy market. That is a stressed system getting a short break because volatility scared enough buyers to step aside for a moment. That distinction matters, because if the dealer backlog eased due to fear, rather than because the underlying metal balance improved, then the next surge in demand can recreate the same problem all over again. That means what looked like relief may actually be an intermission. The pressure did not disappear. It paused. And when the head of a major dealer describes this period as one of the most extraordinary the market has ever seen, that should stop people cold. This is not language used for a normal fluctuation. This is not routine business talk. It reflects a system that was genuinely stressed. And if the infrastructure on the retail side was pushed this hard, while deeper structural deficits were still unresolved, then the next leg higher in price is not likely to arrive in a calm, orderly environment. Now we get to the fourth piece, and this is where the tension becomes dangerous. There are still tens of thousands of March silver call options sitting in the money. That means the crash did not do what it was supposed to do. Because when prices slammed violently into options expiration windows, the goal is obvious: knock calls out. Crush momentum, break psychology, reduce the number of profitable contracts that might become more serious obligations later. That is how the game is played. But despite that massive smash, a huge block of bullish positioning survived. That matters because every in-the-money call that remains alive is a surviving pressure point. Most will not exercise. Many will close for cash. That is normal. But in a stressed physical market, the incentive changes. When the exchange price is lower than what some real buyers appear willing to pay for metal, exercise becomes more interesting. Delivery becomes more interesting. Arbitrage becomes more interesting. Now put numbers on it, and the scale gets uncomfortable fast. Each silver futures contract represents a large amount of metal. Multiply that across tens of thousands of options, and suddenly you are staring at a theoretical volume that dwarfs what people assume can actually be demanded without consequence. No, they will not all convert. But they do not need to. In a market already dealing with physical tightness, premiums, supply stress, and direct mine purchasing, even a modest shift toward more aggressive exercise behavior can matter. That is why the survival of these calls is such a problem for the shorts. The crash was meant to solve this. It failed. And every dollar silver recovers brings more pressure back into the structure. Every rebound reactivates contracts, revives conviction, and invites the question nobody wants to answer honestly. What happens if more market participants decide the exchange price is too cheap compared to physical reality and act accordingly? This is where all four signals merge into one picture. Policy is telling you silver matters strategically. Miners are telling you real buyers are paying more than the quote. Dealers are telling you the physical market already experienced operational stress. And the options structure is telling you the paper market did not succeed in clearing the bullish pressure out of the system. Different angles, same message. The paper price is not resolving the shortage story. It is fighting it. And that is why silver's recovery matters so much. After the crash, silver did not behave like a dead market. It did not collapse and stay broken. It started climbing back, grinding higher, reclaiming ground. That is not how a truly exhausted mania usually looks. When a real bubble dies, the rebound is messy, weak, and full of apathy. But when a market gets smashed below where physical and strategic realities say it should be, rebounds can look very different. They can look stubborn, like the price is trying to find its way back to something more truthful. And gold's bounce matters here too, because the metals complex is not moving in a vacuum. Capital reacts to policy shifts. It reacts to strategic language. It reacts when governments effectively admit that some prices are too important to be left broken. Once that idea gets into the market, the sell-off story changes. Suddenly the crash no longer looks like proof the cycle is over. It starts looking like an engineered dislocation inside a bigger trend. That is a very different narrative. One says, it is over, move on. The other says, they slammed it, it held, and now the floor is being built underneath it. And that is why sentiment can shift much faster than people expect. Once the market starts seeing silver through the lens of policy support, physical premiums, strained dealer infrastructure, and surviving delivery pressure, the idea that the quote on the screen is fair value becomes harder and harder to defend. None of the structural problems appear to be solved. The supply deficit story did not go away. The physical premium story did not go away. The direct mine deal story did not go away. Strategic demand did not go away. More parts of the market are now confirming the same tension from different directions. So when people ask whether the rally is finished, the better question is this: finished relative to what? Relative to a paper mechanism that keeps needing violent resets to maintain control? Relative to a dealer network that just spent weeks under strain? Relative to a mining market where realized prices are already floating above the benchmark? Relative to a policy backdrop that is moving toward support for strategic materials? Finished compared to which reality? The synthetic one or the physical one? It can stay detached for a while. It can be pushed around. It can be bullied lower in the short term. But eventually it has to answer to the real market. And the real market is starting to leave footprints everywhere now. Not because any one headline by itself changes the world, but because all of them landed together. A policy signal from the top, a pricing signal from the mine, a stress signal from the dealer, a pressure signal from the options market. Stack those on top of one another, and the outline becomes very hard to ignore. So where does that leave silver? In my view, it leaves silver in one of the most explosive setups of this cycle. The governments are stepping in. The miners are being paid above quote. The dealers just lived through a demand shock. The option pressure is still there, and the recovery is already underway. That is not the look of a finished move. That is the look of a market trying to reprice while parts of the old system are still pretending nothing changed. You can print contracts, you can slam futures, you can cool retail buying for a few weeks with a brutal drop. You can create temporary relief in dealer pipelines, but you cannot print silver. You cannot instantly create new mines. You cannot force industrial users to stop needing the metal if it sits at the center of their production chain. And once policymakers start treating a metal like a strategic asset, you cannot easily put that genie back in the bottle. They are all telling you the same thing in different language. Silver is no longer just trading as a commodity. It is starting to trade like a strategic shortage with a broken paper overlay. And if that reading is right, then the next move is not just about price. It is about recognition. Recognition that the posted quote stopped representing the whole truth. Recognition that physical reality is overpowering paper assumptions. Recognition that the old playbook is getting less effective every time it is used. The question is whether the market is ready to fully price what just happened. Is silver heading back toward the old highs first, or does it blast straight through once this disconnect becomes impossible to hide? And what happens when more buyers decide they would rather secure real metal than trust the quote on a screen? What number does silver have to reach before the paper market loses the argument completely? And when that moment comes, does the move happen slowly or all at once? Drop your target in the comments. Where do you think silver goes by the end of 2026 if a strategic floor is built under the market and physical premiums keep widening? And if this breakdown helped connect the dots, subscribe now, because the next phase of this story is not going to be driven by headlines alone. It is going to be driven by the collision between paper price and physical reality. And that collision may already be starting.